Good morning, traders. It's nice to be back here with another informative content or educational content. In case you are new here and you don't know me, my name is Ato Forex. I'm your best friend. Subscribe to my channel for easy notification in case I post any content, and also subscribe just to support me and because you like my content. Today we are going to look at something so important and beneficial to you as a trader. We are going to learn more about chart analysis in theory, not in practical but in theory, because I want you really to know what chart analysis is. Chart analysis is also called technical analysis. Actually, they are the same. This is to understand much more about the market technically. This technical analysis is being applied on the chart that shows you more about the prices in the forex market. It is the study of the movement of the chart to understand behavior and predict the future of price direction. From this chart analysis or technical analysis, you can also learn whether the market is trending or ranging, because these are the behaviors of the market. You can also learn there where are the buyers and the sellers strongest, when is the best time to enter the trade, because you cannot just enter, you need to know when to enter and also when to exit. All these things are learned in technical analysis or chart analysis. And also lastly, you can also learn when you should exit the trade. Chart analysis generally focuses on price, time, and volume in the same forex market. What is chart analysis involved? One of them is price action. The pure price action is done on chart analysis. Price action is the pure movement of price without the use of any indicators. And there are a number of things in chart analysis that can be used to understand or to know the pure movement of the price. And one of the things we have candlestick pattern. This helps you very well to understand how the market is moving. And also we have support and resistance. These are also used to determine how the price is moving. We also have supply and demand zone. These are also other ways you can understand the movement of the market. Trends and ranges. It can also help you to understand more about the movement of the market. Breakouts and fakeouts. So if you understand these things and how to use them, then I'm sure that you can easily know the direction where the market is moving to. Let us look into chart pattern into detail. What is chart pattern? These are shapes formed by price that repeats over time. In these shapes, one of them we have double top and then double bottom. Price keeps on repeating these patterns and these shapes again and again. The next one we have head and shoulder. Price also keeps repeating this again and again. Trend, channels, flag and patterns, wedges and triangles. If you understand these things, you can also easily predict the movement of the market and its direction where it is heading to. Subscribe, like and share, because I know that this content is helpful. Share with your friends so that they can also get the knowledge. Let us also look at the volume analysis. This is still under chart analysis or technical analysis. Volume analysis shows strength behind move. Volume analysis simply works best in stocks, crypto, futures, but forex has thick volume. Therefore, when volume increases, there can be strong moves, and when volume decreases, there can be weak moves. In chart analysis, we also have technical indicators. Technical indicators are also used when you want to know the direction of the market, because some traders are not good at identifying the direction of the market by using price action only. Therefore, they end up using indicators. And these indicators, you also have to learn how to use them, because you cannot just use them without being knowledgeable about them. What are these technical indicators? Technical indicators are mathematical formula applied to price data, which shows us the open, high, low, close, volume to help you interpret trends and momentum in the market. Indicators do not interpret the market. They help you understand things like trend direction, strength of movements of the market, volatility of the market cycles, overbought and oversold conditions. Indicators are mainly used for confirming your chart analysis, finding entry and exit points, reducing emotional decisions. Categories of technical indicators. Categories can also be known as types of technical indicators that we can use in our analysis. One of them, we have something called trend indicators. This helps you to understand the direction of the market. One of the indicator for that, we have moving averages. This shows us smooth price data to show the direction. These indicators can be SMA, which is simple moving average, and then EMA, which is exponential moving average. Example how it works: if the price is above 200, EMA, which is exponential moving average, it means that the trend is up, or it is an uptrend. When the price is below 200 EMA, it means that the price is going downtrend. That is one of the indicator and how it works. And then the other indicator, we have MACD, which is moving average, convergence, divergence. It shows strength and direction of the trend using two MAS. If the signal is bullish, MACD will cross above signal line. Remember, there are two of those MACDs. When the signal is bearish, MACD crosses the other one below. We also have momentum indicator. This one shows the speed and the strength of the price movement. One of those momentum indicator, we have RSI, relative strength index. This one ranges from 0 to 100. If it is above 70, it means that the price is overbought. And when it is below 30, it means that the price is oversold. And then for divergency, it means that there is a reversal of the price. Therefore, you have to be so careful. The other type of indicator also, we have stochastic oscillator. This one just shows that the price is moving too fast. Subscribe, like, and share if my content is valuable to you. Even if it's not valuable, still subscribe and share. Therefore, if the stochastic oscillator indicator is above 80, it means that the price is overbought. And if the stochastic oscillator is below 20, then it is oversold. We also have a volatility indicator. This one simply shows how fast price changes. One of those indicator, we have Bollinger Bands. It is consists of middle MA, upper band, and lower band. When the band expands, the market is volatile. And when the band contracts, the market is on consolidation. We also have ATR, which is average true range. Here, this one shows how much price moves on average. It helps us to set our stop loss distance. For traders who don't know how to set the stop loss, they can use this indicator, and they can surely help them. Then with volatility indicator, this one measures the buy and the selling strength in the market. It reads volume flow to predict trend strength. We can see how chart analysis and indicators can work together. Indicators should only confirm the price but should not replace the price action. Price action is the best and it is what you should learn in case you want to trade Forex successfully, but not to rely on the indicators. Here example, you should identify an uptrend. When it is an uptrending, it will show you higher high and higher low. That is where now you can know that the price is really going uptrend. When the price is going an uptrend, 50 EMA slopes down under the price, of which now it can confirm you that the price is going an uptrend. The RSI makes a pullback to 40 or 50 range, which now shows you that it is a good spot to enter. ATR says a range movement is 30 pips. Therefore, you can now use it to set your stop loss. That is only when you are using those three indicators in the same time. That's what you should consider. As I've just explained to you, it is you to first spot the trend and then use those indicators to confirm when you should enter and also when it is really an uptrend and when your stop loss is to be set properly. The biggest mistake traders make are that they use too many indicators. You should only use 1, 2 or 3 indicators, not using too many indicators in the chart. They use too many indicators because they think that indicators can predict the market. Therefore, they ignore market structure, which is not good. Instead, they should first consider market structure and then they use indicator. Indicator cannot predict the market moves. The other mistake is they only trade those signals without context, not understanding why indicator gives signals. You should know that indicators they lag behind and price moves faster than the indicator. For the professionals, how they trade, the price and the indicators are quite different from the beginner traders. So how do professionals do it? They first identify trend with price action. Then, as I said before, when the trend is trending, the chart will give you a higher high and higher low. That is the first thing a professional trader or a good trader can do. Then they will really confirm if that is an uptrend using the trend indicator of 50 EMA to really confirm the trend direction. Then they'll use RSI for the entry. They can now enter when RSI pulls back to 40 or 50 in an uptrend. For the downtrend, they can enter when RSI pulls back to 50 or 60s. That is it, trader. It's not that difficult. You can watch this video again and again, and I believe that you'll understand it well and go and practice it. You'll see the changes in your trading result. I'll see you in the next one. Bye.